Hi, Ken Boy with Accounting Accidentally. This video is called 5 a.m. Shoppers, Black Friday, and Gross Profit. So here are some Black Friday statistics from Wiser Notify. And the first thing, many Black Friday shoppers start early, with stores opening as early as 5 a.m. There's nothing I want to buy that's interesting enough or compelling enough to get me to buy and get up at Friday morning at 5 a.m. to go shop. However, lots of people do. Some other statistics. Over 25% of online sales came from mobile devices last year, 9.5 billion total sales. 124 million plus people shopped online during Black Friday. The average discount on Black Friday was about 31%. And the last interesting statistic at the bottom, 64% of consumers will shop online this Black Friday, 36% seeking deals on social media. A guy who was one of my editors, writing editors years ago at QuickBooks, runs a business that helps companies do social media really well, and Black Friday is their biggest sale day. But this year is a little different. So as we go to the next slide, which is the Wall Street Journal, shoppers are pickier this year. Retailers are looking for Black Friday to reignite tepid demand from budget-minded shoppers who have been hesitant to spend this year unless they're getting a good deal. Why is that? Although inflation is cool, prices have not reverted to pre-pandemic levels. They're still comparatively high. As a result, shoppers are continuing to pull back on discretionary purchases like clothing and shoes, discretionary, spending more on food and other essentials. So the family budget is shifting more money to food and essentials and less money to things people buy on Black Friday, like discretionary purchases. So as a retailer, it's harder to make a living selling online. Which brings us to the accounting portion of this. So this is a company I made up, Premier Gifts, and let's assume that this is their pro forma income statement for 2024, and it reveals some things you need to understand about how a retailer thinks about profitability during Black Friday. So the way I set this up with, we assume that you were pro forma, that you're planning for 2024, you come up with some average balances, and we calculated those average balances as a percentage of sales. So cost of goods sold, gross profit that I'm going to explain in a minute, going all the way down, and to come up with the 2024 pro forma or forecast, we take our sales number of 1.4 million and we use the percentages over here to come up with the numbers in the left-hand column. So we're going to assume that cost of goods sold is 30.8% because that was the average over the years that we looked at. So this is just a tool to create a what if or pro forma income statement. So what a retailer is thinking about is several key things. Cost of goods sold are direct costs, direct material, direct labor that you incur for a product or service. If you're a retailer and you buy inventory, that would be cost of goods sold, because when you sell an inventory item, it moves from an asset inventory to a cost of goods sold. So cost of goods sold is typically the biggest cost number. Then we get to gross profit, which is the difference between sales less cost of goods sold equals gross profit. Now, what do we do with that remaining gross profit number to get down to net income at the bottom, full profitability? Well, we've got to subtract operating expenses, depreciation and amortization. Amortization is a decline in value of an intangible asset like a patent or a copyright. Interest expense, taxes gets all the way down to net income. So what can the retailer control or manipulate to try to increase profit? Well, they can go to suppliers and get cheaper quotes on direct material. They can find ways to operate more efficiency and lower direct costs. That would both lower cost of goods sold if you're a manufacturer. If you're a retailer, you're negotiating with suppliers to get lower prices on what you buy into inventory. Operating expenses, maybe you get cheaper leases on retail space. Maybe you save money on advertising and marketing dollars. Depreciation and amortization probably locked in since your fixed asset list isn't changing, neither is depreciation and amortization. So the two big things that the retailer can do to try to increase profitability is, can I get cost of goods sales lower? Can I get operating expenses lower? Operating expenses are not directly related to the product or service that you sell. So it's lease payments, utilities, professional costs for lawyers and accountants, etc. These are the two ways that the retailer can increase profitability. So the wrap up here, if you're a retailer competing for clients on Black Friday with consumers who are more picky on pricing, the two ways that you can improve your results are to look at lowering cost of sales and operating expenses.